Look at it. Look at how much the CPI and PPI have come down from their peak. I would argue we're getting very close to that range that we've historically been in. I mean, just look at that graph. You can see we're getting, really close to where we've always had inflation, where the Fed wants inflation. Welcome to this episode of Market Shares. I'm your host, Tony Blodgett, and today I got a handful of topics that I just want to run through with all of you. And the first thing is this graph right behind me. Now, I got to give a huge shout out to Dan Rawich, and Dan runs University of Options, and he has a website, dolikedan.com. You can follow along and do trades with him. He's got a class where he teaches you how to do options. I can't say enough about what Dan does, but he also, every Sunday, if you're signed up, he does a market mentor video that he puts out every week, and he gives a slideshow along with that. So I think we're zoomed in too much when we put it up here on the screen. It cut off the bottom where it says dolikedan.com, but check out Dan's stuff. But these first two slides that were on this Sunday's, update, in my opinion, kind of sum things up very well. And it might be zoomed out here, but it's pretty obvious what you see behind me. So quick overview. The blue line is the CPI, the Consumer Price Index. The yellow line is the PPI, the Producer Price Index. Yeah, I got those right. And as you can see, if you follow along the graph here, I'll just bring my microphone with me. You follow along the graph here, you can just kind of see this is 2011 is the far left, and then it goes along, and we kind of stay in this range as far as inflation goes. And then if you look to the far right, you can see where it dipped down, and then it spiked up here over the last, 2 years, year and a half, 2022, that's that spike. And then as we've talked about numerous times on this podcast, look at it. Look at how much the CPI and PPI have come down from their peak. I would argue we're getting very close to that range that we've historically been in. I mean, just look at that graph. You can see we're getting really close to where we've always had inflation, where the Fed wants inflation. But yet, what are we expecting at the next Fed meeting? Of course, they're going to raise interest rates again. So this is it was just so glaringly obvious when you look at a graph like this that the Fed probably should slow down. But you know what? It doesn't sound like they're going to. I think we're like a 90% chance of a Fed rate hike at the next meeting, despite what we see with inflation, and it's clearly coming down. Now, he had another slide in there that did talk about the job growth, and we've definitely seen, especially in the area of hospitality, there's definitely been some strong job growth there, but we're talking about some of the lowest paying jobs out there. And so not all hospitality jobs, I don't want to generalize, but a lot of these are low paying jobs that we do see coming into the market. And so I don't know that that's sustainable. Now, there was some other strong areas like construction and some others. So we have a very resilient employment market. There's no question about that. But look at this graph. I mean, it's so obvious to me that inflation, this is the ramifications of COVID and all the stimulus that was done. And it looks to me like it's flowed its way through. So I don't know what the Fed's doing. They're going to keep going. But when I see things like this, I just couldn't ignore it. And but to get an update, from Dan, check him out. He's got great information. Now, another thing I wanted to talk about was housing inventory. There's no inventory right now. It is like an epidemic problem nationwide. There is just no inventory. And some would argue that the really high interest rates and really high home values, are, otherwise would be problematic, but because there's so little supply available that it's okay if there's weak demand as long as there's even weaker supply. And we've seen the housing market, as far as market values, be very resilient. Matter of fact, it's been going up. Values have been going up here in the last couple months. They peaked in June of 22. Some markets saw some modest decreases, some saw some more significant, and we saw that kind of bottom out, values coming back up. And a lot of that is contributed to the fact that there's no inventory despite the challenges with affordability. And by affordability, I mean higher interest rates, higher home values, making it more difficult for the average consumer to want to buy a home, but even qualify to buy a home in many cases, especially first-time home buyers. So let's talk about that inventory thing, because what could lead to more inventory? I mean, we all know that close to 80% of all mortgages are under 4%. I think it's over 60% are under 3% of all existing mortgages. So those folks definitely are not going to want to list their home and buy a new home and trade up for not only a more expensive home because they've gone up in value, and most people are increasing the size of their home when they move up, but they're also going to have to take a significantly higher interest rate if they do it right now. And so we all think that, look, as rates come back down, which they should, but as rates come back down, more people will be likely to become sellers, finally do that move up purchase. And I think, quite frankly, there could be quite a bit of pent up demand for that, right? People may have, their family size may have grown, their situation may have changed. Maybe they had to get a job that's farther away and they'd like to buy a home closer to their new job, but it's just not feasible to do it in the current market. So as rates come down, obviously that's going to create some more inventory. But what are some things that might create more inventory in the meantime? And I think there are a few areas out there that people may not be considering about where inventory might come from. So I'm going to list off 3 of them. And the first one is institutional buyers. So I think over the last number of years, there was a lot of institutional buyers who purchased up a ton of homes. I mean, we heard of investors, and I mean like hedge funds, buying up whole neighborhoods, complete neighborhoods. But what will happen is if rents start coming down, which rents have come down, I don't have a graph for that. Maybe on the next episode, I'll cover more in depth what's happened with rents, because rents are definitely a factor when it comes to what people are willing to pay for housing in general. But rents have started coming down. That's part of why we see CPI coming down as well, right? Because that shelter component of CPI that includes rents and rental equivalents, and that number has been coming down. So if rents are coming down, and now there is a lot of competition in, you can just invest your money into a money market account right now and make close to 5%. You can buy treasury bonds for, 5.25%, right? So if that is the opportunity that's out there, and we see institutional investors not feeling like they're getting the same amount of return, and they've built up some equity in these homes they purchased, you might see some inventory start coming on the market from institutional investors unloading some of their portfolio, or perhaps just diversifying that portfolio into less risky, more stable assets. That's one area we could see inventory come from that is not dependent on current market rates. The other area is just your average consumer that is a landlord, either someone who moved out of their home, bought a new house in the last couple of years, and retained that home as an investment property. Same thing. If rents are coming down and they're no longer cash flowing like they were in the past, they might consider letting that home go, finally taking that equity out of there. using that for home improvements on their home, consolidating debt, investing in other areas. So you might see just your average landlords start to let some homes go if they're not receiving the same amount of cash flow, or dare I even say, perhaps be in a negative cash flow position. The third area where we could potentially see some inventory come from is with Airbnb, that short-term rental market. There is a lot. This is almost, to me, the short-term rental market is almost like reminiscent of some of the, exuberance around housing that we saw back in 2005, 6, 7, leading up to the crash. Now, obviously, not anywhere close to the same magnitude. But what I mean by that is there's people who frankly have no business being an investor, meaning they don't have the experience, they don't have the business plan, and they don't have the reserves to deal with a downturn in that market. And I know a lot of people who've purchased 1, 2, 3, 4 even short-term rental properties, and now you're starting to see that those aren't getting booked as much. There's a lot more vacancies in that. And it's not because necessarily the Airbnb market has taken a huge downturn, because I don't think that it has. I think in certain markets, there's just been so many people have wanted to get into the short-term rental game, right? I mean, it is the big buzz right now. It's all over YouTube. It's all over, especially young investors, people that are buying Airbnbs instead of even owning their own home. We see that out there, and it's because there's been a lot of talk. It's been very popular thing to do. But again, these are not super qualified investors, obviously qualified enough to purchase the home. Many of them purchased them back when it was a lot easier to acquire a second home. And so they fell into those second home underwriting guidelines and interest rates. And now they're just finding they're not keeping those booked like they were. And it doesn't take more than a couple months for kind of that average consumer who happens to be, a short-term, a short-term property landlord to decide, you know what, this just isn't fun anymore. This isn't worth it for me anymore. And they might start selling, some of those homes. And that's another area where we could see inventory come back to the market. So I think there's a lot of concern that we're never going to see inventory return. And I just listed off for you 3 areas. Now, all of these are kind of dependent on what rents are doing, right? I mean, if rents go down, it's going to create a situation where people that are holding those properties, people that are landlords, whether it be long or short term, are going to have to reconsider what their investment strategy is. And there's alternatives now. There didn't used to be these sorts of alternatives where you could just put your money into a money market account and make 5% pretty much guaranteed. That is competing for those dollars. And I'll tell you what, my money market fund's not going to call me at 10 o'clock at night because the refrigerator stopped working or the washing machine sprung a leak. You know what I mean? I'm just saying, being a landlord isn't easy. And so when other difficulties are created in the marketplace, people may decide to back away from that. And so there you go, guys. There's a few ideas on what could create inventory. Now, here's the question. Is it possible that we start seeing these inventory numbers start creeping up as a result of these things? And in the meantime, rates stay high, home values stay high, and all of a sudden we find ourselves in a little bit of a softer real estate market. I'll tell you what, I don't know the answer to that, but I'm going to bring on an expert in one of our future episodes, and we're going to unpack whether or not that is likely. Now, here's my prediction. I think that it's going to be very healthy, quite frankly. I think there was an unhealthy amount of people that were converting homes into Airbnbs. Everyone was keeping their current residents when they bought their next home. There's a lot of that going on. And so I think it's natural for some of that to just unwind. And it's part of the reason why we've had such low inventory in addition to the low rate. So I personally think that, as long as it happens in a healthy, kind of rollout of that, shouldn't be a huge risk. And look, let's be honest, based on what we're seeing behind us here, interest rates are going to come down. We know that interest rates spiked up exactly following the graph behind me, and they will come down following the graph behind me, just like they always do. They're lagging a little bit right now, but they will come down. So as interest rates come down, that's going to help make things more affordable. At that point, we could use some of this lift in inventory. Frankly, couldn't come soon enough, but could it be too much? I don't know. We will have to find out. So I'm going to bring on a real estate expert. We're going to talk more about that topic, but something for you to think about and ponder upon. If you have thoughts on it, please leave them in the comments down below. And also, look, if you're watching this on YouTube, give us a thumbs up. And we are working to push this content onto other platforms as well, so that you can listen wherever you catch your favorite podcasts. So keep your eyes out for that in the future. But in the meantime, like and subscribe to the YouTube channel. Please leave a comment down below with what your thoughts are on these couple topics. And until next time, you guys take care. Bye for now.